Today we're going to review our simple Forex trading strategy, and we're going to talk about my favorite MnW setups. Stay tuned, traders. We'll be right back. Good day, traders. I'm Stacey Burke from Stacey Burke Trading. Hopefully everybody's been able to capture some of the movement this week in the markets. We've had some spectacular moves overnight, the indexes as well, oil. But in our specific strategy for 50 pips a day, our simple strategy, we focus on some basic setups. We talk about structure, the high and the low of the day. We're going to answer some questions. I've been receiving a ton of questions, and again, thanks for all the feedback, the great questions, and again, thank you for hitting the like button and subscribing. My goal is to provide you with content that will help you improve each and every day with your trading journey, and just sharing my own experiences, what I try to do each and every day in live time, and the real challenges that come up, and why it's important for me especially to simplify everything down to a couple of simple steps that each day I can reproduce. I mainly follow the British pound crosses, but I will look at any market where there's an opportunity where we can apply our simple strategy. Today I'm going to just talk a bit more about the MnW patterns that we talked about last day. I'm going to talk about my favorite setups, and also we're going to review this again because each question, some of the questions repeat a lot over and over again, so we'll try and clarify some of the questions by going over this and then sharing some screenshots from yesterday's markets. Big days, lots of movement, but a lot of traders found it difficult. And we're going to talk about first structure again. We talked about this in the last couple videos, looking at the bigger picture. Big rectangles, highs and lows of days, highs and lows of multiple days, forming a bigger geometrical shape. I like horizontals. I'm not really big on diagonals. The only pairs that I really look for diagonal patterns on are descending and ascending triangles, but they're a very specific type of setup which we're going to talk about today. But structure in general, we want to look at the market breaking out of levels and either trending and positioning ourselves in the direction of the stronger underlying trend. Now there are certain days when we will trade between the high and the low, or within a certain number of pips, 75, 100 pips, but we're looking to work from the high and low of the day. If you're ever not sure about what you're looking at, then don't trade it. That's the easiest number one thing to do, is don't trade it. If you're not sure what you're looking at or what you're looking for, don't trade that day. Step back, but the number one thing to do is to identify the high and the low of that session or that day. Now, often throughout the day, those highs and lows will change. So if we head from one session into the next, we obviously have the previous day's high and low, which we've talked about. That's important. Has one of those borders been broken by the current day that we're trading in? Has either the high or the low been violated, broken out of, whatever that may be? If not, we're still inside of that previous day's trading range, which comes back to looking at the round numbers, because typically we'll be trading inside of round numbers or back and forth between a set of numbers if we have not yet broken out of a high and a low. Just something to mentally be aware of, because chasing the candle action will often get traders worse fills. They'll get caught into traps. They'll be caught up high when it's a selling setup. They'll be caught down low when it's a buying setup. So again, coming back to the high and the low of the day, it's important to always be very specific about being able to identify that, because that's where we want to be working from. If the market's making new highs and we're trying to counter trend or sell that high, you're going to get caught into a market that will keep coming back against you, when what we should be doing is waiting for that market to make a new high and then at some point give us a trend trade, confirming a new low for either the reversal trade in a trend, back with the trend, or if it's off of a high and a low in a sideways market, we want to be positioning ourselves on one of those types of W patterns that we looked at, or an M pattern that we looked at. Very important. But again, if in doubt, stay out. That's the easiest number one rule. You're going to end up losing money. Chances are you'll be in a losing position if it's an uncertainty. But also, why do you want to take that risk on? Why do you want to play a 50-50 game? we're trying to set ourselves up to be in that percentile where we have a high probability of at least not getting stopped out. So I mean, the trade may not take off and explode, but there may not be a lot of stress in terms of getting to break even or to exiting the trade. Or if you position yourself properly in the right area at the right time, the trade will usually be over with very quickly in 3 or 4 candles. So very important. If you're not sure where the high and the low are, or you have questions, just stay back and observe and look at other pairs to see where you can spot a high and a low. The timings are critical because even in a market that's moving strongly, like yesterday is a great example. The market's been moving strongly all day. As soon as we get into the 12 candle window, it goes into consolidation. So there's a golden rule that I use. If the market is moving before the 12 candle window, you're probably going to go from a ranging market into a consolidation. So now, if we have a 12 candle window and a market goes into consolidation, in the back of your mind, you need to be thinking that hourly rotation. And in most cases, if there's going to be 3 pushes either with the trend or against the trend, that will typically be between 2 and 3 hours. So if that's the case, then we also talked about the rotation of that hourly rotation, the end and the beginning of the hour when the market will potentially make its move. So if we have a 2-hour window at least of consolidation, then we're looking at 3rd hour, possibly the end of that hour or the beginning of the following hour, or the beginning of that 3rd hour, depending on when that consolidation started. Very important. If the market's been in consolidation heading into our 12 candle window, then most likely you're going to be able to expect a move in that 1st or 2nd hour. The next important part to understand about that 12 candle window is that if the market is going into consolidation in each session, we've talked about this, it will establish a high and a low within that 3-hour window. So if the market is, as market profile people call it, out of balance, and it goes into consolidation, it will make a new high and a new low, which brings us back to high of the day, low of the day. If that is the case, then when we come out of that consolidation, we'll either be selling high with one of those types of M formations, or buying low with one of those W formations. In most cases, if it's gone into consolidation, it will be a type 2, because that's at the high or at the low of the redrawn high and lows. Very important. Hopefully that makes sense. We'll look at some examples because we're going to review yesterday. And then we look for engulfments and pin hammers. When a market shifts, it will usually engulf a candle because it has trapped volume either up high or down low. And when it makes that engulfment candle, it's trapped that volume and the market is now ready to move. So we've had 3 hours possibly of consolidation, of trapping volume either up high or down low, or even having, if it's a down market, we may have sellers trapped down low where they hit the stops for the final shift. So again, you can think in both directions. Traders can be trapped down low and up high within that consolidation. Asymmetrical risk reward. So that comes back to our understanding of geometry and structure. If we have a consolidation that's built up with a high and a low, now we have geometry in our new redrawn high and low within that bigger pattern for a potentially measured move of 2-3 times that distance. So if we're risking maybe 15 to 20 pips, we may be targeting 50, 100, 75 pips in that area. So again, we talked about squeezing as much out of your winning trades as you can. And part of that will come with time. And initially I suggested just focus on targeting 40 to 50 pips and getting proficient at executing and managing those trades. And then again, the last part, trade management and self-management, or mindfulness. I like the term Mike Bellafiore uses, and I use this a lot, sitting back and just reminding myself and being an observer of yourself and how you're performing. So if I'm at the screen and I'm looking for a trade or I'm anxious, I just calmly remind myself, I know what my best trade setups look like. I know that I'm thinking in the hourly rotation. I know that I'm looking for a sell high or a buy low setup. And I just calmly remind myself, if I was to look at that chart tomorrow is it a perfect setup? And I know I've reviewed thousands of these charts now. That's all it needs to take sometimes for me to look at the screen and go, that's not a trade. And that's sort of where you want to get to, is constantly sitting with yourself and talking to yourself and being observant rather than anxious and trying to figure out where to get in and all those things. You should already calmly be rehearsing, visualizing, using imagery, self-talk, all the things that will help you prepare like a skilled professional athlete, so that when you go in there, you're at the top of your game in terms of knowing that you have that unconscious confidence to execute your trading plan and focus just purely on the best setup. So you're not worried about the erratic movements of the market or the flashing prices or the impulsive movements, because you have an idea of what your perfect setups look like. And there's a great reason for just sticking to those, because they're the ones that when you trade them, they work strongly in your favor. And some aren't going to work, but when you execute your trading plan properly, it's very low stress, because you followed all the steps, you've accepted your risk management on the trade, you've accepted that it could be a loser, but you've followed your process, and the outcome now is outside of your control, but you've done everything within your control to execute that to the best of your ability. And that's critical, because you can duplicate that, you can manage your psychological capital. That's the biggest thing you need to protect, is that your knowingness that you will execute properly in live time and not be subject to emotional or irrational impulses, because that's when there's no consistency. That's when you lose hope that you can actually do this properly, instead of focusing on the action steps and creating solutions to all the little things that will sabotage your performance. You need to try and remove all those things and replace them with things that will support you performing to the best of your ability to execute your process and focus on your best setups. So hopefully that makes sense. Okay, so today we're going to talk about why type 3 M's and W's are my favorite setups. Now, in one of my previous videos, I talked about one of my favorite sell high setups. And yesterday we talked about type 1, type 2, type 3 M's and W's, when we want to look for them. But I have to say type 3 are my favorites, because for me, they're something that I can pick up on really easy. This is sort of similar to my sell high setup. It is a type 3 selling high setup. Same thing with the W formations. They don't always set up exactly the same in terms of being reverses of each other. The sell high setups, I must be naturally bearish by nature, because I can spot these really easy, and I love those when I see them, and they tend to be easy to spot. They tend to move steady once the trade is confirmed with an engulfment or a pin hammer in the direction of the trade. They tend to move very steady. There's very little stress or heat. It doesn't hang around for a long time. In worst case, it will stay sideways underneath or on top of your entry position for a half an hour, but they tend to never really go against you, but they often move very steady or quickly to their destination. So if it's a stop hunt, it will move fairly fast. If it's trending, it can auction a little bit up and down towards its profit target, but they tend to be very low stress. They're easy to manage because they tend to move quickly or steady, so getting to break even, you're not usually stressed about having to move to break even. There's the time constraint. You're usually in profit within a 30 to 45 minute window, and it tends to move quickly after that. I hate to say they're high probability, but they usually are when the setup is right. They tend to have a very high accuracy rate. They tend to be with the trend. In a lot of cases, they will be continuation moves in a trending market. Now, often we can see them when the market is turning, but again, there will usually be a peak formation already in place for the session. Obviously, if we're going up, we'll tend to have a peak formation low in place. If they're going down, they'll tend to have a peak formation high in place. So that is often easy to spot. As I said, they tend to be low stress, and they don't tend to hesitate around. They tend to move usually in the direction of your trade fairly quickly. The cons, they're sporadic. So usually we can have them 2 days in a row on the same pair. We saw that this week. But sometimes you may not get an ideal setup in 1 week. Now often there tends to be at least 1 or 2 of those every single week, and at least one on one of the pairs. But sometimes we can get markets that are sideways or range bound and they don't move in that similar pattern, so it's not guaranteed that you're going to get one all the time. The illusion with those types of trades is that you get those trades and you think that you figured out the market, and you go to the market the next day looking for that same setup, and of course it's a completely different day and you're caught in chop and you're trading it and you get smashed. But if you start to develop that preciseness with identifying the pattern, they can be very high probability when they present, and they're the types of trades that I personally will be willing to take more size on. They're my ideal setups for taking size. Now sometimes they'll move prior to the 12 candle window, which again we see that occasionally in a market that's maybe getting ready to take off, and it accelerates prior to the 12 candle window, which the downside of that then is that if the market's already moved, it will typically consolidate in the mid move, where again I don't like to be at the screen a lot, so if I miss the original move from the break of that M or W, then the problem is you have to come back and wait. So it's not often that happens, but sometimes on a Friday or a Monday, if it's a continuation day, we will see that accelerate earlier towards the end of Asia before getting to the London window, which just means there will be a sideways consolidation before a continuation happens. We'll look at some screenshots of those. I would encourage you to develop your best playbook setups, the ones that you resonate with best. Now I typically really like the type 3 M's and W's, and we'll look at some setups of those today. Traders who try to counter trend those markets will get smashed. They're the days that you do not want to counter trend. I have a note on my desk that says DNC, do not counter trend. Just a reminder to be on your game, identifying the big structure, the high and the low of the day, the timings, the round numbers, and of course engulfments, pin hammers. Asymmetrical risk reward. There's been 50 pips a day, if not more, in almost every session on at least one of the pairs. So stay focused, traders, stay disciplined, just keep getting better, stick to the highs and the lows, and may the markets go with you.
Alright traders, we're just going to review again, talking about type 3 M's and W's, but we're going to review type 1, type 2, type 3. So we talked about type 1 being outside of the Asian range, 25 to 50 pips before reversing with either an M pattern, an M formation, or a W formation. Type 2 typically will form at the high or the low of the session. And type 3, of course, is the M version at the bottom of the session. Type 3W is at the top of the session. So almost where a type 2 can catch traders selling high, traders may be looking for the buy low on the type 3 when it's actually a type 3 M pattern, and vice versa for the sell. They may want to be buying low in the type 2 W formation when it's actually a selling formation, and vice versa. So just again to reiterate, outside up high for the type 1M, at the high of the day for the type 2, and down low at the session for the type 3. And vice versa for the W's, down low outside of the range at the low of the day for type 2, and at the top of the range for a type 3 W formation. And we'll take a look at some examples of the type 3 setups today. This is a great example of a type 3 M pattern. This one actually happened in the London session. We have our low of the session from Asia. The market pulls back and gives us a swing high as we head into the Europe-London Open. The market hits the highs and drops down, breaking the lower boundary of the Asian session before pulling back, dropping down again at the last candle of the second hour, and then going 1, 2, sideways 3, and then an engulfment pattern and little inside bar for the breakdown. Traders would have shorted the engulfment for our type 3 M formation. And as we talked about, they tend to move fairly quickly. They tend to be easy to manage. There's not a lot of hanging around. But again, at the low of the range, traders might have been looking for a buy-low setup when it was actually a type 3 M formation. I'll just put this in the middle. And again, just looking and keeping it simple, you can call this a trend trade, whatever you like. Obviously, we look back, the market was in an uptrend. So an example of where a type 3 M pattern can show up in a reversal situation, but a great example of a type 3 M, very low stress. They tend to move quickly, and again, not a lot of resistance to that trade. Another example of a type 3M, but just a different subtle variation, but a good example to explain a couple of things. We have our low of the Asian session. The market breaks down after a swing for a redrawn high of the day. So we're at the low of the 3-hour window. Market breaks down before pulling back into the Europe London Open, sideways, and then a pin hammer for the continuation of the move down. And this is an example of a sloping M pattern. So we have our first side of the M, the market's falling, and it rolls over. And again, this is a great example of where a market has already accelerating into possibly the final move. So there was a 50 pip move and then 75 before consolidating inside the low of the session for the pullback. Stop hunting traders who were short. But just again, an example of a type 3, they move quickly. There's not of stress on the trade. They're over reasonably fast. They reach their target, but just a different variation of how that market was already starting to move and how the London Open completed the pattern. An example of a type 3 variation of the W. So we have our high of the day, high of the session, high of the previous day. The market makes a low before pulling back and making a smaller micro version of a W off the low of the day where it reversed before coming up and then pulling back. And this is an example of what I talked about where the market was already aggressively moving prior to the 12 candle window, and traders are sort of faced with chasing that move. But again, this is where I suggested to wait till the market goes into consolidation, gives us a high and a low, and we can see the 3 push pattern down. This was prior to payrolls, but an example of a type 3 that was accelerating prior to the 12 candle window. And again, just a variation of how these markets can move quickly. Another example of a type 3W, we have our high of the Asian session and our low, and the market pulls back before giving us our very easy to spot W formation just prior to our 12 candle window. But again, the pin hammer is our confirmation of this trade holding and moving after the engulfment. So traders ask, I would enter myself on the pin hammer and into the 12 candle window. You could enter. I would enter in on any one of those candles into the move prior to the breakout. Now the pin hammer is an example after the engulfment prior to the 12 candle window, but also in our 12 candle window where the reversal engulfment also appeared. So the type 3W was our initial trade. This was the continuation of the trade, as was the other engulfment outside the 12 candle window. But another example of an accelerating market, very fast, very little stress on the initial trade for the 50 pip move, and traders who entered in on that second leg. Obviously, as that trade progresses, it may fatigue and pull back a bit more, but we saw heading into the U.S. session it moved very strongly. But again, type 3 up near the high of the day prior to the 12 candle window, but an example of where the trade was already in play just prior to the window, where traders may have been able to participate with a very tight risk reward. Another example of a type 3M pattern, we have our low of the Asian session and our redrawn high after the swing. The market breaks through and pulls back, breaks through again before pulling back into the London Open on an inside bar and moving down through the range. This market didn't quite go the full 50 pips, pretty close, but again, towards the end of the 12 candle window, we have the extended W formation setting up. But again, just painting the difference, there's a very of the variations that will show up. But again, the low of the Asian range, the market broke out, pulled back, gave us our middle structure, and then a double inside bar. Again, very tight risk reward, a 1-bar stop for 40 to 50 pip move, which was a stop hunt to the blue tracer, the blue previous day's low. And again, the market went into consolidation on top of that range without going through it. So traders who were maybe holding on for 50 pips may have had to exit with 40, somewhere in that range. But another example of a type 3 variation. Move very quickly, very little stress to the heat. Again, traders may suggest this is a trend trade. The problem with that is that when we get down to the bottom of the range, traders would miss the reversal trade back up, such is why sometimes using EMAs and different things will throw us a curveball.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.